I would like to welcome back to the Options Tribe Scott Andrews of InvestaQuant. And actually, Scott and I are going to kind of double team you guys today in our presentation about keys to success in trading weekly options. Weekly options is one of the most popular topics among options traders. And so we thought you would all appreciate some insights on that. So we're going to go ahead and first of all, welcome Scott. Thank you for coming to the Options Tribe.
Thanks for having me, Seth. Good to be back.
So I want to give everybody a little quick, interesting history lesson about why we're making today's presentation and what this is all about. And so I'd like to mention that if you remember the crash, the COVID crash, they're calling it now, which it really started in late February. And by early March, it was beginning to dawn on everybody that we got a serious problem here. And in fact, I was up at the Money Show on March 9th to make a speech, which had been long scheduled before that. They did not cancel the Money Show. I think if it was 1 week later, the city would not have allowed them to have that Money Show. But in fact, I met a number of you there at the Money Show for the first time, which was fun. Well, during that day, Scott and I met for the first time. And it turns out we were both heading back to SMB's office that afternoon. And so when I saw Scott in the office, I got to talking with him. You know, I wanted to know more about what he did because he was actually working with SMB on some other project. And he told me that, you know, the many things that InvestaQuant does. And one of them is they have developed 1-day market signals, directional signals on the market. And I said to him, you know, for years, I've been looking for a good 1-day signal or really any signal, but certainly a 1-day would be great. In which I could combine credit spreads, which most of you know is a directional option strategy, with the signal to increase the win rate and the probability that the credit spread trade would work out and become profitable. So Scott and I both got excited about this idea, and he went back, sent me some data that I needed to do a back test. And when we did the back test, then I started to get really excited. And we saw that the returns from combining his signal with credit spreads was very promising, had an excellent win rate and excellent returns. And so the timing couldn't be better because this all started when the pandemic started. And as a result, all of us were kind of couldn't travel, couldn't do much. We're shoved inside. And so what better time to do intensive research on a strategic concept that requires a lot of back testing. So it turns out the pandemic, while it was been a negative for almost everybody in every way, was very good for this project. So Scott, I'm going to let you go ahead now and introduce InvestaQuant.
Very briefly, I was fortunate as a young man to start a technology company from scratch right out of my dining room and with some childhood friends, and we took it public. Really crazy, fun, exciting story. And I'm very proud of the fact that company survived. I was CEO for several years. And when I left the company, I had a little bit of a nest egg. And as I explored what to do with that nest egg, I stumbled on this idea of actually trying to actively manage and trade my own capital, thinking it couldn't possibly be that hard, right? So I went looking for strategies that would take advantage of the volatility I just personally experienced. We took our company public in the .com boom, and we wrote it up and we wrote it down as well. And what I wanted to do was avoid the overnight exposure, because that seemed to be where the bulk of my losses seemed to occur in the market while taking advantage of intraday volatility. Didn't find anything that met my goals. So I ended up hiring a good friend and our first developer of our first company, who's now with InvestaQuant, Dave Skowron, to help me do back testing. I'm not even sure we knew what that term was back at the time, but we started looking for patterns and ways to take advantage of intraday volatility, and quickly migrated to trading futures. And over a long several year period, finally built some models that stood the test of the time. And in fact, if you want to go back to InvestorQuant, we ended up having enough success with our signals. We started attracting a following back in 2008 and turned it into a nice small business. We're selling our signals to other retail and professional traders and investors who just wanted diversification. We had enough success doing that a core group of probably 15 or 20 clients actually came to me and suggested that we raise venture capital and take our approach that we had developed, that by that time it evolved into something we called ensemble forecasting. It's a multi-system model. They want us to scale it into other markets and manage money, basically. So we weren't so sure about managing money, but we took the capital and built the infrastructure, and ended up being several $1,000,000 to bring in the team and the tools necessary to build a real sophisticated, basically day trading forecasting engine, which is what we have built and traded with our own capital, with quite a bit of success. So much so that we were able to actually start managing capital. We went down that path, started a type of a hedge fund, essentially called a CTA, a commodity trading advisor, a few years ago, and was privileged to actually manage capital for some really big names in the space. Co-founder Peter Boris, co-founder of original co-founder Tudor Investments, and he was, if you watch the movie with Paul Tudor Jones and Tudor Investments, how they started it. Peter was the original systematic quant. In fact, maybe the first one I've ever read about or heard about, going back 30, 40 years ago. So I was really excited that he gave us the opportunity to manage some capital for them, and we had some success as well. Anyhow, long story short, we, for our whole career, we've been pretty much a signal service type of company in different forms and fashions of licensing signals and research to people, and been very fortunate to work with the likes of SMB, Mike and Steve, and their tremendous group of traders. And I was very fortunate to meet Seth, as he just explained so eloquently. So you'll hear more from me soon, but with that, I'll turn it over to you, Seth.
Very good. Thank you, Scott. And so let's drill down into what exactly we've been up to for 8 months. And it really has been all of 8 months. And I can't tell you, it's got to be hundreds and hundreds of hours of work between the two firms. So what I want to start out with is explaining what we've been looking at. In order to do that, I have to be really sure that everyone understands how index options work. Most of you do, so I'm going to do this very, very quickly, but there may be a few here who don't, so we're just going to go through that real quickly. So first of all, index options are settled in cash. They're not in shares as with equity options. So an index call, for instance, pays $100 per point above the call strike price on expiration. But if the index closes below the call strike price, then that option expires worthless. And the same is opposite, for puts. An index put pays $100 per point below the put strike price on expiration. If the index closes above the put strike price, then that option expires worthless. So there is your quick review of index options. As an example, if you buy a 3010 SPX index call and the market rallies to 3015 on the day the option expires, then you'll receive $500, 5 points times the amount that the market got past the short strike. But if the market rallied to 3010 or lower, you get nothing. Your call turns to nothing. It turns to zero. If you buy a 2985 put and the market sells off to 2975 and closes there on expiration day, you'd receive $1,000 because the market sold off 10 points past the short strike. 10 times 100 is 1,000. So there you go. Now that's your quick and dirty primer on how index options work. Now, index call credit spreads are very close, but it's just one more layer of complexity. A call credit spread is a short call plus a long call above that. Both options are in the same expiration, and the trader receives a cash credit at the outset of the trade because the short call is closer to the money than the long call. And so obviously there's more risk that short call could be violated, and therefore it costs more. And the long call that you pay for is going to be less expensive. So what you receive in cash minus what you pay out in the long call as your protection is going to create a credit. Cash comes into your account upon you're entering into this trade, and it's a bearish trade. If the index closes below the short call, both the options expire worthless, and you get that full credit as your profit. So you want the market to go down with an index call credit spread. An index put credit spread is the exact opposite. You sell a put that is at one location, and you buy a long put below that. The short put is always going to be as it's higher on the strike chain than the long. You're going to get more money for that one. Again, you're going to receive a credit, but in this case, it's a bullish trade. You want the market to close above that short put. Okay, I am guessing that I surprised virtually no one in this audience because this is a group of primarily made up of experienced options traders, but just in case, want to make sure and spend 2 minutes going over that stuff. Now, so what we decided to do, Scott and I, was to, believe me, we can go through this quickly, but the amount of work involved was unbelievable. Probably the biggest effort I've ever had since I traded options. And so why did we choose to study credit spreads as the strategy to trade Scott's signal? And the answer is because the credit spread has many layers of protection before you can lose. So let's run through why I'm saying that, what those examples are, okay? Number one, we're going to take an example of where Scott gave us a long signal. And these are actual, by the way, these are actual examples historically from when Scott's system flashed long for a particular day. So his system flashed long on March 9th, 2018. And so the index opened at 2756 that day, and we got a long signal. So in this case, we sold a 2750, 2730 put credit spread. All right. And remember, the market opened at 2756. So when the signal is really right, very right, it went up 30 points from the open. Okay. It increased 30 points from the open. Then what happens to these two options down here, the 2750 and the 2730? They both expire worthless because the options are expiring on that same day. These are one-day trades. So what's the cash flow of that example? Well, the 2750 short we sold for 445. You multiply that by $100, as we said before, for a $445 cash infusion into your account, but you also had to pay $95 for the 2730 long put. 95 cents times 100 is 95 bucks. And so therefore you net them out and your credit's 350. Well, the index closed 30 points above where it opened. Therefore, the 2750 to 2730 both expired worthless. So you just get to pocket that 350 in premium. So that's the clearest case. The signal was really right, and it was an easy trade. All right, now let's move on to, that's case one. The signal's really right. The next case is the signal is slightly right. Okay, so when the signal was slightly right, let's take a look at an example. This day, the market opened up at 29.23. All right, so we're going to sell in this case. Which spread we're going to sell is subject to a pretty complicated discussion that we'll get into a little bit later. But just suffice it to say, we're going to sell the 29.20 put, and we're going to buy the 2900 put. Okay, so the index opens at 29.23. Our short strike is 29.20. Market's 29.23. It closes 1 point higher. All right, so the signal was correct. It was a rally day, but not much of a rally, right? Well, guess what happens to your options? Well, the 2920 and the 2900 both expire completely worthless. So here's the cash flow. We got $400 in. I don't want to go run through the math on every single one. So just trust me, in this example, you made $400. You didn't make it, you received cash of 400. The index closed above both the short and the long put, so you get your $400 credit by the end of that day. That's a full win. So now we have the market was really right, and the market was slightly right. In both cases, it was a full win. Now, how about when the market's flat? Doesn't happen too often, but it does happen. Here, the market opens up at 27.83. In this example, we're short the 27.80, 27. We sell the 27.80, 27.60 put credit spread. All right. We go to the end of the day. The market moved up 20 cents. We're going to call that flat. I hope you all accept my poetic license to call that a day. You know how rare that is for the market to move so little on a day. So that's a flat day. Okay. And so therefore, the index didn't move at all, but because we were 27.80, 27.60, we were just right below the open price. We sold it. Market didn't move at all. The signal really wasn't right. The signal was nothing. The day was nothing. Guess what happened? The $508 we got, since both of these options, that number is wrong. That should be 27.60. Since both of these options expired worthless, then that $508 that we got in the beginning, again, we pocket. So when the signal's really right, we have a full win. When the signal's slightly right, we have a full win. When the market is flat, we have a full win. Okay. So in 3 cases that are obviously 3 extremely common cases, we win the full credit. Now, when the signal is slightly wrong, let's take a look at this example. It's slightly wrong, but it moves against the signal's direction, but not as far as the short strike. So for example, in this case, the market opened 27.77. So we sell the 20.70, 20.50, okay? 20-point credit spread. Now, the market sells off to 27.74. But we were at 27.70 and 27.40. So both the 27.70 and 27.70, 27.50. So both the 27.70 and the 27.50 expired worthless. They're both below that 27.74 close, even though 27.74 was below the open and therefore the signal was wrong, but it wasn't wrong by enough to even invade the 27.70 short put, and therefore we get to pocket the full $230 credit. So you win when the signal's very right. You win, and I mean the full win. You have a full win when the signal's slightly right. You have a full win when the market's flat. You have a full win when the signal is slightly wrong, but not as far as the short strike. Okay. Now we're going to take a look at a partial win. And in a partial win, what happens is this is a case where the signal's wrong. And we're going to look at how we set this up. 29.32 is the 29.32 is the opening price of the market. We sell the 29.30, 29.10. Sorry, 29.30, 29.10. And the index sells off to 29.27. So it has invaded the 29.30 short put, whereas the 29.10 put is going to expire worthless. So the market sold off. The signal was wrong, but let's take a look at the math. We got in $300 initially. The short put pays $2.80, 29.30 minus 29.70.20. That's $2.80. You multiply that by 100, that's $280. So the short put pays $2.80. The long put is nothing. It expired worthless because it was down at 29.10, but we collected $300. And so therefore we won, even though the signal was wrong. The market sold off. We got a long signal. The signal was wrong. The market sold off, and it even went through the short strike, but it didn't go so far that we lost money. We actually made money. All right. So we looked at winning in every case so far. The market's right. The signal's really right. Sorry. The signal's really right. The signal's a little right. The signal isn't right or wrong. It's just flat. It's a little wrong. It's a little more wrong. All right. Now, when it's very wrong, that's when the short payoff exceeds the credit. Okay. When the short payoff exceeds the credit, then you have a loss. And so let's take a look at an example of this. The market was trading at 27.30. We are therefore short the 27.30, 27.10. The market sells off 12 points. Now we can't handle that loss. All right. And in this case, then we received $465, but the market sold off to 27.1860. We were short to 27.30. That's an $11.40 violation, so to speak, of the 27.30 put. And therefore, multiplied by the $100 per point, you have an $1,140 payoff of that short put. The long put expired at 27.10, expired worthless. So you got no real protection from it. You just got nailed on your short put. You had that 465 credit, but it wasn't nearly enough. And so you ended up losing that trade. So don't want to bore you, except to say we've now shown you all the cases. You win in every case except the final case. And so in 5 out of the 6 cases, we win anyway. And so what was our thesis? Our thesis was, well, that we may have something here if we have a signal that maximizes the number of times these happen. In other words, a signal that's either right a lot, or when it's wrong, it's not wrong by very much. And when it's right, it's, it's right a lot more often than it's wrong. And when it's wrong, it's not really that wrong. If we can find something like that, and on March 9th, I had no idea if we had something like that or not. It was just a hypothesis of an experiment. Then maybe we got something here. And so the hypothesis was an accurate signal would maximize the winning cases, minimize the losing cases, and hopefully have a really great system, and a system that is would be have a very, very positive and outstanding return. All right, so I am now that I've run you through the options aspect of this venture that we were involved in, we're going to go into the deep dive of the back test that we did and what we learned from that back test. So Scott, I am going to turn the floor over to you now so that you can go ahead and run through the back test. Now, the back test, by the way, was a joint venture between InvestiQuant. We did a lot of the work at SMB. InvestiQuant did a ton of work as well for reasons you'll understand in a minute. And so as a result, it was a really joint effort to go through this back testing. And I think Scott's the best guy to go through that. So Scott, go ahead.
Thank you, Seth. Yeah, totally a joint effort for sure. Could not have done any of this without Seth's expertise and help, and other members of his team, as well as other members of my team, many bodies and smart people involved. And one quick thing that probably the most important thing I failed to mention in terms of my bio that you probably should know is that my first 2 years as a trader was spent actively either day trading or swing trading options. So that's how I got started, and I'm proud to say I actually made money my first year. How many people can say that? In retrospect, it was a little bit more luck than any skill for sure. But I've done many short-term trades. And with that said, using options. And with that said, there were a lot of questions that Seth and I had. We had many other questions other than the ones shown here. But these were some of the main ones and the ones that we'll be covering today that I want to share our research. So our goal is to share some of our learnings. It was a massive amount of work, hundreds of hours by multiple members of our team. And hopefully you'll be able to put some of this to good use with any directional signal that you may already have, or perhaps with some information that Seth will share with you later. But the first thing that was most important and obvious to us was, do we want to be looking at going in the money, at the money, or out of the money? So strike selection was huge, as you can imagine, for all the obvious reasons. Rounding maybe less so, but rounding meaning basically, did it matter and how much did it matter? The distance between where the market was trading versus the near strike when we were executing the trade. Day of week, we knew that it mattered because with weekly options, as you know, they're only available Monday, Wednesday, Friday, or I should say they expire on Monday, Wednesday, Friday. Tuesdays and Thursdays, you have to hold to those days. But we wanted to see what the difference was in the results for trading different days of the week. Implied volatility, or the volatility regime as I think about it, wanted to see the impact of that. We knew that was a big one. but we didn't know how much we're really with any of these. We had our own speculations and guesses that Seth and I enjoyed essentially betting on. He was right more than I was. Entry timing, entering at or right at the open, 9:30 a.m. Eastern time or 9:45. Was it better to wait 15 minutes? We didn't know. And then something I'll get into more at the end. It's not as fun of a topic, but it's important. And it's a discussion about the actual opening price of the SPX. We won't be going into it today. Hopefully most of you recognize some of the advantages, but if not, you can reach out to Seth for why we chose the SPX. But we did focus on the SPX. And one of the known issues, if anyone that's ever tried to trade the SPX, is you can't, right? It's a cash-based index, market-weighted index representing the 500 subcomponents in the S&P 500. But there's an issue, if you've traded for a while, that you're probably aware of regarding the opening price. And we'll get into that in greater detail. So that's what we'll be covering. Some research parameters, just so you know what you'll be looking at. This material is pretty dense, and for Option Tribe members, I believe you guys get access to the slide deck. So we put together and took some time to put together some good quality slides that are hopefully self-explanatory. So be sure to ask for them, but I want to make sure I cover at a high level the big picture of what generally applies to most of the research we're sharing today. So first and foremost, what is this IQ or investor quant signal that we'll talk about? We refer to it as an adaptive signal because it's not just any signal, it's an adaptive signal. Very, very important for reasons I won't go into. But the signal is actually derived from multiple systems that we have built over the past decade, pulling the whole ensemble, as we call it, together in 2013. And we have traded derivatives and off this signal, this engine of multiple systems aligning to create a directional edge for us with futures since 2013. So about 7 years, not only ourselves, but clients, and it was the backbone of our own CTA, commodity trading advisor account that we managed many people's capital with and large sums of capital with some success as well. So they work, and they work well with futures, but never as great as we thought they could work, as I think Seth mentioned before, because they tend to be directionally right at a far greater rate than our ability to trade them with intraday stops. And that's really just due to the intraday volatility, right? And we could have a whole discussion on why that is. But it was something I always wanted to explore. Seth, as you mentioned, jumped right on it when we first had the conversation. But that's what we're going to be showing you today is the results of using options, credit spread specifically, every time the IQ signal triggers. And that trigger is based upon the S&P 500 futures, which is highly correlated, as I'm sure you know, with the SPX. And we're using the regular session hours. It's a one-day trade using the closest expiration. So if it's a Monday, Wednesday, or Friday, obviously we're choosing that day and it expires at the end of that session. If it's a Tuesday or Thursday, then the trade is obviously closed. It's a one-day trade, so it's closed on Tuesday and Thursday, but it's using the expiration information for Tuesday and Thursday. Slippage and commissions have been included here, so we haven't skipped those, and they're not a big factor overall. But they are included and they are a factor. And most of the data I'll be showing you is based on all the available data we could get out of the backtesting software that we and SMB have. And that's from January 1, 2018 to present in 2020. Now you'll see different dates. I think the earliest date you might see in any research I show you is April, because remember we got started pretty early after Seth and I met in late February. Most of it's probably in May. You may see some dates September and even present. So
Scott, let me jump in just to make one point of clarification that most people probably realize, but some may not. And that is up until January 1st, 2018, there were not Monday and Wednesday expirations. There were only Friday expirations on the SPX index. So because this is a Monday, Wednesday, Friday expiration based trade, where it's traded on, if it's traded on Monday, then it just expires that day. If it's traded on Tuesday, you have to close it at the end of the day, because then you're trading the Wednesday options and so forth. Those Monday, Wednesday, Fridays did not exist until January 2018. Before that, it was only the Fridays and not enough. There aren't enough Fridays in a year to be able to have a business of trading options with 1-day signals, which might come on a Friday, but they you know, 4 times out of 5, it's not going to come on a Friday, right? It could come on another day of the week if it were to generate as often as once a week. So, go ahead, Scott. Just wanted to pound that.
You know, that's a fantastic point.
Yes.
Exactly right. And as I mentioned, our signal's been triggering for 7 years now. So that wasn't the issue. It was really just the lack of weekly options data prior to 2018. And one thing I actually want to clarify as I was looking at it, and you were speaking, Seth, that the data we use for trading our own live signals don't include early close days. So any day in which the U.S. equity market is closed early, like day after Thanksgiving, we just have one, is probably the best example. And there are 2 or 3 others that occur throughout the course of the year. We don't include those because A, I don't want to be trading on those days. B, liquidity is super low. And in general, we do not trade and have built into all of our models after this year, and as they were as we encountered them at in the spring of this year, circuit breaker days in which the circuit breakers triggered in the futures markets and literally shut down. Those are too risky, so we do not include those days in our own trading. That said, I cannot promise you all the data and all that I'm going to show you has excluded. It's a handful of days in which the circuit breaker days triggered. But because we don't have outsized wins, right? This is not an outsized win type of strategy using credit spreads. They're really not material.
Scott,
Yep.
we want to clear one thing up. Tim's asking, so he's basically asking, so you tested 2 years, and the answer is no. We tested 2 years and 9 months. We ran it right up through September 30 of 2020. So it's 39 plus 104, whatever that is.
Yeah. Well, some of the data I'm going to show does stop in May when we conducted the research initially, because I did not have time to go back and update it this weekend. So I believe it's still valid, and we'll talk more about how we modeled it pre-2018 as well, just for further validation. That's the big picture. Yeah, and I'm counting on you to look at the questions and just quarterback them to me as needed.
Yep.
All right, so the big picture I think is should be super clear here was, can we use credit spreads combined with a quality directional signal like we have in InvestorQuant and increase the win rate of the signal? Remember, our win rates were not as high as we wanted trading futures intraday. And then with credit spreads, they have that the flexibility of the credit itself actually capturing and turning small losses into actual winning trades. Could we do that, and could we prove it out? And secondly, could you do so in a profitable manner? There's plenty of high win rate strategies out there that lose lots and lots of money and or are just waiting to lose lots and lots of money. So we wanted to make sure we could build a true, robust, high trading system. So strike selection. First thing we looked at here, we looked first at the 5-point spreads. We thought at the money would be the best way to go. So on the far right, you see 1 strike in the money. That means we were rounding towards the direction of the signal, and it actually had the lowest win rate, which makes sense, versus going out of the money, the direction opposite of the signal, because it gives us more of a buffer. And we picked up about 3.5, 4 points in percentage in terms of win rate. Profitability in terms of average annual return was roughly the same. And the average annual return versus drawdown, also known as CALMA ratio, was roughly the same. And you can see the equity curves underneath here. Seth, can you guys see my arrow when I point?
No.
Yeah, no. I'm doing it.
Right.
So,
so you want me to, I will point to what you're talking.
That's fine. Yeah, to the degree you can, that's fine. It's not critical that we do that. And you can see the equity curves, they're roughly the same. Nothing too exciting for either one of them. And this was a little bit of a surprise, I think, to both Seth and myself. Both, we thought right around the money would possibly give the greatest returns. When we started getting further away out of the money, you can see what happened. The win rates improved dramatically, and more importantly, the profitability improved dramatically as well in the back test period. So that was one of our key takeaways. And I'm at a very high level summarizing a lot of time and a lot of discussion, obviously, that went into this topic. But this was the broad takeaway. So basically, the larger and out of the money spreads showed better win rates and profitability than the smaller and in the money spreads for our directional signal and the back tested period, in this case, about 2.5 years. The next topic was one of rounding. And again, we'll have time for questions. I hope at the end we can come back to some of these slides if need be, or again, just interrupt me, Seth. Impact of rounding. So the whole concept here, this is really two related pieces of information. I've got a table on the left, and then on the right is just a simple example. So the table on the left just shows that in that 2.5-year period, we took all of the days in which the near strike, the one we were selling, was less than 5 points away from where the market was opening, and took the credit. That was with a 20-point spread. We use a lot of 10 and 20-point spreads in the research here. It was about $500. So the average round amount was right at 2.5 points. And then we compared it versus the times in which we were opening almost the full 10-point strike, more than 5 points away from the near strike, somewhere between 5 and 10. Its average was about 7.5 points. And we compared the credit received in those scenarios. I was expecting this to be a much bigger number, but it wasn't. It was only 14%. And what's surprising, maybe it's not surprising in retrospect, but that's probably because of the volatility that we've had since 2018. Whether it's a 2.5 point round down, if you will, or 7.5 points, that's just not much relative to the average true ranges that the markets have experienced, specifically the SPX, since 2018. So, and then just on the right, it just sort of shows it visually. The further you get away from your near strike, the one you're selling, in this case, the 29.90 example, the less money you're going to make. So the takeaway, the greater the distance the market's trading from your short strike, the less credit you're going to receive. But the greater your odds.
It would have been very hard for anyone to kind of guess that, right? That, and that's why this back testing is so important, because if you just stop any options tribe member on the street and say, if you round down more than 5 points, how much is that going to degrade your credit? I don't think anybody could intuitively answer that question, but this research did.
Right, and that was the whole idea, is that we knew that it was too overwhelming to try to tackle everything at once. So we had to break it down into what we call factor analysis and just do deep dives into every single factor. And we would take a week or two on every one of these. And that's what we've been doing. As Seth mentioned, maybe the only good thing that's happened in this COVID pandemic that we've been experiencing. It gave us lots of time to do that. All right, so next issue was day of the week. We were really excited to see the impact here. And this was surprising. I personally didn't really have any idea how this was going to play out. And I'm only looking at one side of the equation here, which is the credit, not the debit. We just don't have enough time, but I'll talk about that in a moment. Monday, Wednesday, Fridays, we received less than we received on Tuesdays and Thursdays in terms of the credit, more than 20% less. So that was really a positive, right? And suggested that Tuesdays and Thursdays would be possibly the better day to trade these one-day signals. What's really interesting, and you just got to read the takeaway there, is that what we found was that often we were closing out with larger debits. So disproportionately larger, meaning more than 20% than the additional credit that we received, resulting in a lower trade expectancy for Tuesdays and Thursdays. And I do want to acknowledge some of this, and this is important because we had to use some proxy, and we told you how we came to be with our signal, the InvestorQuant signal. So that's just the proxy or example we're using here. If you're using any of these concepts and you have your own directional signal, just please keep in mind, our signal is a variable, meaning it's different than your signal if you're applying this information. So trust but verify is always the rule of thumb here. And in this particular example, I can tell you, I know that our signal is a little bit weaker on Tuesdays and Thursdays, or at least it was in the, has been in nearly 3 years of testing with weekly options for reasons I can't quite explain, frankly. But it is what it is, and over time, maybe a reason will become more clear. Implied volatility. So this was the whole idea of, is the market volatile and expecting to remain so for the coming month or not? And we could have split these things any number of ways. I honestly don't remember why we chose these particular VIX levels. It may have been due to standard deviations, or we may have just eyeballed them. I don't remember. I don't think it really matters, but we got comparable sample size. That may be the actual reason we did it with these 3 breaks here. When the VIX is less than 15, 15 to 25, and greater than 25. And the average credit received changed dramatically. Just quick math there, you can see it was about a 40% move one way or the other off of medium volatility. So in a low vol environment, we were getting about 40% less credit, $334, versus in a medium VIX environment, $504, versus a high VIX environment, $692. So pretty significant, and much more so than we saw with day of week and the rounding down amounts. So the greater the implied volatility, the more credit you receive. But I do want to point out, and this may be subtle to you, but the lower your odds of a profitable trade for a given spread amount. And think about it this way. Think about what we've been through this year, right? We've had average true ranges, right? Daily ranges for the SPX well over 100 points, right? So when the SPX is, say, at 100, a 5-day average true range of 20 points, and you're using a 10-point spread, even a 20-point spread, the odds of the open to close move exceeding 5, 10, 20 points spread, which is less than 20% of the total average daily range, is high. It's very easy for the market to move and close beyond your levels. So you're getting paid. That's why you're getting this extra credit. You're being compensated for the extra risk that you're taking. It's harder to predict. Contrast that with a low VIX environment. To think like a low grinding bull market, VIX often less than 15. A 20-point spread would be a huge move, a 20-point move, right? To be wrong by 20 points. And I will say this about our signal, just to help you also compare and contrast. If any of you who do have your own directional short-term signals, our signal is its strength is that it isn't wrong, completely wrong very often. It's either going to be right directionally, or it's not going to go in the direction where our stop is. It tends to be very strong in that regard. So 2 out of the 3 scenarios, it's very strong, and that's important, and that's why this credit spread is also another great way to monetize that type of signal. But those are the dynamics going on behind the scenes of some of these stats. So this next table I put together because I thought it would be helpful to see sort of the interplay between these, because these are not discrete, independent variables that occur on any given day, but they're in play at the same time, right? So any given day is going to fall into these buckets, and there are other buckets as well, by the way, that we explored and that you should explore as well. These are just some of the more important ones we thought to show here, and that were easy to show. So what you see here are those 3 VIX levels, those 3 columns, separated by rounding up or rounding down, or I should say rounding more or less than 5 points, and then separated by Monday, Wednesday, Fridays versus Tuesdays and Thursdays. So you can see the actual average. Now, some of these cells did not have huge sample sizes, because remember, we're only dealing with about 2.5 years worth of data, but I believe all of them were statistically significant and very, very close. So those were the results that I think are pretty fascinating. Now, I do want to point out also, this is just the credit received. We're not at all trying to imply here that you should only be trading high volatility environments, because remember, a high volatility environment is going to have a lower win rate depending upon the spread you're using than, say, a low vol environment where you're getting less credit, but it's going to have a much higher win rate. So it's the interrelationship there that creates the expectancy or the average trade. So what we found, actually, to be very clear, you can be profitable in all 3 environments.
And I would say the biggest surprise takeaway for me was that round amount ended up being the least important of these 3 factors.
Yep.
Really surprised by that, because you would have thought, hey, if it's 9 points away from, say, a 10-point strike, or 1 point away from a 10-point strike, that should make a massive difference, right? Well, but when you think about it more logically, it becomes more and more logical as you think about it. When in a high volatility environment, the difference between 1 point and 9 points is nothing, right? So what's driving it is the magnitude of the perceived moves, not these little mini things in between. And so that, if the more you think about it, the more you understand why that is clearly far and away the #1 factor.
Yeah, in fact, just along those lines, because we've been trading and experimenting and trading, I experiment with live money, even if it's just one contract always. So we've been trading this since I first met Seth. And I've realized that the old expression, don't be a dick for a tick, is very true here, because I missed entire winning signals because I was so worried about rounding down too much
Right.
when it really had very little impact on what I was going to make. It was really sort of stupid in retrospect.
Yeah.
So you're exactly right. The round amount is probably the biggest surprise. And I think the other thing is, while one day for a long-term swing trader, or somebody's doing like income trading on a monthly basis with some longer holding periods, one day seems like nothing. But in the markets today, one day a lot can happen. And where we open, as you know, and with the current volatility, there's a lot of volatility around the open. The market's going to move around, and it has very little relation. We'll show it when I get to market timing. Very little relation to where it's going to end up. In fact, we'll talk about it right now. So what this shows is, again, same 20-point spread out of the money, and we're looking at 9:30 entry time versus a 9:45 entry time for what we call the raw signal here from InvestorQuant. 154 trades, and simply comparing the difference. And what I was shocked at, the first thing that shocked me is that first number of the win rate's exactly the same. So whether you entered at 9:30 or at 9:45, which results in a completely different credit and a completely different price level where you're entering, right? Adjust the whole spread amount, so on. It did not matter. You got the exact same win rate. So there's no variance there. Average annual return was only about 7% less over the 2.5-year period. Max drawdown actually goes down. And think about that. The reason for it, what I probably should have done or could have done, was show you a comparison of, say, like the last 30 trades where this happens. And you'll see that about half the time, the trade, I should say, the price action is moving in your direction. So it's costing you more and you're getting less credit. But the other half the time, it's moving in the opposite direction after the open. So a delayed entry actually results in more credit because there hasn't been enough time for time decay in the first 5, 10, 15 minutes to be substantial or nearly equivalent to the amount of the move. So pretty fascinating, really. And I would have bet this number was 20 or 30% in terms of the impact. I'm not going to go through all these numbers here. You'll have access to the slides. But bottom line is that the average trade and total profitability about 7% less, waiting 15 minutes versus entering right at the open. So one of the takeaways is I don't stress now personally if I'm entering 10 minutes late or get tied up. In fact, I don't really stress. As long as the signal is valid, I'll enter the trade at any time I can get a credit that meets my needs. I don't care if it's in the first 15 minutes or the first 3 hours personally. So a little food for thought. Now, one thing we wanted to point out, and this is back to Seth's original point, that weekly options did not come into play until January of 2018. And 3 years may sound like a ton of data and a lot of information, and it is nothing to turn away from, and it's certainly valid, but it's still only 3 years of data. And everything I've done personally in my whole career has been based on at least 10 years of data. I think I've built one signal in my life with using less than 10 years of data. I was using 7 years of data in terms of the futures world. So I wanted to go back, and Seth was for it and was willing to put the work in with his team to get us the data, which wasn't available for the weekly options, but to help us evaluate it, maybe a better way to say it, our signals prior to 2018, if we could model using all the data we have for weekly options since 2018. So Seth and his team helped us create essentially regression models that used all these different factors so we could come up with the most accurate estimate for the credit and the debit for every day in which our signals had triggered prior to 2018. So we could just see what would have been the hypothetical, like real hypothetical, right? Because we didn't have weekly options, but what would have been that hypothetical drawdown, max drawdown during that time, and the average annual returns and so on. And I feel really comfortable with the numbers. We did some really great work collectively and came up with some really strong models. And the best part was they stood up pretty well. No giant surprises for us in terms of the signal or the performance of the data. So that was encouraging. And as I mentioned, we've been trading signals live since April and using a number of different models and learning all along. And they've been validating as well and very comforting. So it's been a really good and exciting and fun 6 months for us.
Yes, it has. And so just to summarize this point, because we only had data going back to 2018, because we only had Monday, Wednesday, Friday options available to us then, we wanted to feel comfortable that this wasn't fluky, that that this success wasn't just sort of a function of the last two years and 6 months, or 2 years and 9 months. And so we basically modeled, had there been Monday, Wednesday, Friday options, what credits you would have received under what conditions. And it was complex, but we took into consideration volatility, we took into consideration days of the week, we took into consideration proximity, the rounding up factor, all those things. It's an extremely sophisticated model that was put together to try to estimate what those credits would have been. And then once you know the credit, it's pretty easy to know what the losses would have been, because if it's a Monday, Wednesday, Friday, you know exactly, because it settles at the end of that day. So you know exactly how much your short put was violated or not, right? That's easy. Tuesday, Thursday was a trickier part of the analysis. We had estimates for those as well, but you know the Monday, Wednesday, Friday loss numbers were perfectly accurate because you know where the SPX closed that day. So we feel really, really good about having gone through this process. And what it did was it made us feel very strongly about the system.
Well said. Thank you. All right. So here's the one part, and this is probably the least fun part for some of you, but it's important to point out. In fact, it's critical we point this out to you because it impacted not only our own research, and we had to go back and redo a whole lot of it, which was not a whole lot of fun for either team, but it was the right thing to do. And that is this whole idea of the opening price. So for some reason, I'd assumed the opening price that you get in terms of from various backtesting platforms was, how could they possibly mess that up, right? And I didn't really think through, we didn't think through this whole SPX opening price issue because I knew there's an adjusted opening price that is used to calculate settlements for a wide range of options and a wide range of scenarios that CME uses it. I just assumed that what was shown in these backtesting platforms was accurate and was not that first print that you've probably all seen. And if you ever look at an SPX chart with a giant 1 minute bar, which I'll show you in a minute, but basically the first print that you get on your charts, in fact, I'll just go there now if you don't mind, Seth, the next slide. On the far left, the first print, the bottom of that green candlestick on the far left is not tradable. It is literally the average of a handful or some small subset of the entire S&P 500 opening prices. And then it rapidly, over a number of seconds, sometimes minutes, and sometimes even longer than that, when there's significant moves in the overnight, it will catch up with and align itself with the futures. That first 1 minute bar often looks exactly like the one on the left there. That's a 13-point range. That is significant, when in reality, if you looked at the futures or the spider on this given day, it was only about a 3-point range. It was a nominal range in the first minute, nothing unusual whatsoever. So the mistake that many traders make, and not just options traders, is thinking that they can mirror and match that price and then use that to calculate what the spread would have been and the strike prices needed in order to have a winning trader or not. And unfortunately, it's wrong enough, and it's actually untradeable because that you get from some of these platforms. In fact, in our own testing, about 25% of the opening prices that came out of the platform were completely wrong, and or I should say completely untradeable, meaning they did not even get traded in the first 10 minutes. So there was no way you would have gotten traded. And that's all because of that aggregated rolling open, where it averages these moves across all of these markets. And when they're really big moves, sometimes the opening prices, even though it's an S&P 500 component, the opening prices can take a while because the market maker has to match the buyers and the sellers. So it's a really crazy process. Learned a lot, probably a lot I still don't know about it. But bottom line is, there's an issue. You do not strongly advise that you be very careful and don't use, unless you absolutely have to, I guess, but try not to use the SPX opening price ever for trying to align and estimate opening prices. So let me share a little bit what we've done. It's not super hard depending upon your skill sets. You'll have to do some research on it. But basically, we had to create basically online calculator that we put a bunch of inputs into each day to come up with the relative opening price of the SPX where it aligns with the futures. And futures, and specifically the fair value change in the futures overnight. And you may not realize this, there's actually 3 different futures sessions that are not accounted for by the SPX each day, between 4 and 4:15 Eastern time, 4:30 to 5 p.m. Eastern time, and from 6 p.m. on until the current open. 3 different times, and they're constantly adjusting due to geopolitical news. They're automatically including any dividend components, interest rates, days to futures contract expiration, which occur 4 times a year, at least in the index futures, more or less in other markets. It was a lot of work, but we were able to create a model that does a very good job of aligning itself and identifying where that key component is, which we believe gives us an edge as well, because most people are probably just trading either ignorantly or just accepting the 25% error rate. And in our case, by creating our model here, we actually improved performance, which frankly was a little bit of a surprise versus using the original flaw data that had 25% error rate. So we've been watching and tracking very, very closely for many months now, and pretty excited about this. So, but it's something to be aware of. So just to summarize before I pass it over to Seth, I think we're getting close to about an hour, and then I know we want to answer some questions as well. So over this past 7 months, and I say we collectively, InvestorQuant teams and SMB teams, we've been incorporating these learnings to develop and live trade a variety of different option strategies. We've sort of evolved and found what's worked, what hasn't worked, using a lot of this information I just shared with you. So it's foundational to point us in the right direction. We've created a few that we're really excited about. So there's lots of different models. There are different strike prices, I will tell you. So there's not, it'd be dangerous. In fact, I would advise you, if you go down this path and try to create your own, to not try to create the one best model. You always have to pick one that you're going to trade, but there really is not any such thing as one best model. You really need to focus, if I can give advice, on your own risk return profile. Know your own risk tolerances, work backwards from that. And yes, that means you may have to make less returns per year than you hope to, but that's more important to stay in the game long term. And you got to do that by staying within your risk tolerances. So we've got several strategies we're super excited about. The returns you can see here anywhere from close to 25% up to over 40%, and the drawdowns have been really controlled relative to these returns, and small, less than half of those numbers by a large. In fact, that's not even doing them justice. But it doesn't matter. Very conservative numbers, small drawdowns in live trading, and in their modeling, they've held up as well. So
yeah. And
that's
just
where we
one
are.
quick point I can make to a group of experienced options traders like Options Tribe members is there's no adjustments on these trades at all. There's no, you don't have a stop. Your long strike is your stop, basically. You don't have a stop. You don't have an adjustment. There's no discretion, literally zero. You just follow orders. And there's no choices to make. You just enter the call credit spread or the put credit spread based upon that day's signals direction, and then you let the market and your broker sort it out. It's not, these numbers are not subject to, a lot of times you'll see back testing numbers, but you'll dig into the strategy and you'll realize that there's a lot of discretion in that strategy. And so you don't know if you can really completely 100% rely on those back testing numbers. Well, there's nothing to do. You just get into the trade, and I mean, there's work to do, but you just have to enter the trade and that's it. There's no adjustment. There's no, you don't get out of the trade if the market is going against you in the first couple hours, because for one thing, you all know, especially lately, that can turn around very, very quickly. Okay, so you don't do anything. You just let the trade play out. It's what options traders would call a set it and forget it trade. So very good. So Scott, that was really great. You hate, if all the work that we did between the two organizations, to see it down to 11 slides, you almost feel like people has no idea what one of those 11 slides. There is so much background data and blood, sweat, and tears that went into this. It's a little hard to describe when you look back at it, but it was a lot of fun, and fortunately really gave birth to something, really exciting. So in the near future, SMB and InvestiQuant are going to be partnering to bring you an actionable video course trading system. We're going to include group coaching, and it's going to be based on our 9 months of research, and it's going to involve a lot of the subjects we discussed today, but we'd like to wait a little bit to give you, a more full presentation of exactly what that offering is going to be, and we will get into that in the very near future. So that really is our presentation for the day. Before we take questions, I'd like to, before we take questions, I would like to just make a couple quick announcements, and then we can jump back into some, I guess we take about 5-10 minutes worth of questions. We've gotten a ton, so we'll have to kind of sort through them. But anybody who's here for the first time and has no idea what either of us were talking about, it's probably because you are a newbie in options. And then in that case, we have a free 2-hour workshop to get you going as an options trader. And the way you would do that is by going to optionsclass.com to register. And then we're going to teach you 3 option strategies that are very powerful, and it's free. So anybody who was sort of struggling to keep up with what we were talking about today, that's a good place to start. Also, if you would like to see a recording of today's webinar, as well as over 500 other webinars that we've held since 2011, as well as the copies of Scott's presentation today, which was something very in-depth and you may want to study. Plus, you get 5% off of all optionstribe.com video courses and mentoring. With all that, it's only $30 a month, and please go to optionstribe.com to join. It's a very, very good value given how many options webinars we've done over the last 10 years on all sorts of subjects, every option strategy you can think of, and way, way, way more. Well, also, SMB offers a number of advanced strategies for developing intermediate and advanced students as well. You can find all those by going to optionstribe.com and clicking on trading courses. It will bring you to descriptions of all of these courses. Scott, let's try to dig into some questions here.
There's a bunch of them. It looks like there's more in the chat.
Yeah.
The first question, if you want to go, depends on how you want to do it, from Glenn about why not debit spreads.
Okay, why don't you do that? Sure.
Well, I'll let you handle that one.
Yeah. Well, I mean, what we were trying to do was make it intellectually simple, Glenn, and that is if you have an out of the money put credit spread and the market goes up, then both options expire worthless. If you have an out of the money call credit spread and the market goes down, the options expire worthless. It's very easy to calculate. It's very easy to explain to people, and it's very easy to understand. I personally find debit spreads a little harder to teach to people, even though it's just the inverse. I just sort of find it a little less, most people have a little less comfort thinking in debit spread terms than credit spread terms. And as you know, they both debit spread and the credit spread, the same strikes on this are of the put side or the call side, whether one is a debit and the other is credit. They're both economically the same trade and will fill at the same amount. Okay. There's no way we're going to get through all these questions, but we're going to try to kind of get through some important ones that have come up, maybe indicative of what other people were asking. So let's see. Tim is asking, in what percentage of the cases was the indicator itself wrong?
I'll handle that one. So the actual IQ signal, which I think is what he means, win rates varied over the past 3 years between 65 and 69% on the raw direction of the futures. And then with some of the numbers we showed you, we've got bumps of 10 to 15 percentage points. In fact, some of the strategies that we have sort of settled on are actually having higher win rates in the 80% and higher, which I know that sounds sort of crazy, but remember, the whole advantage of these credit spreads is that there's only one scenario out of what, 6, Seth, that you lose money, and that's when the signal's really wrong, which is something, fortunately, is somewhat rare.
That's right. Glenn is asking, with SPX, is the spread always 20 points? And the answer is no, Glenn. We've adopted a variety of strategies, and when we share with you what we're going to be offering everybody, You'll see that there's varying levels of wing width that come into play, and 20 points is one of them, but there are many others. So Walter's asking, are you putting on trades all 3 days of the week? Walter, I would say, when you say all three, you mean Monday, Wednesday, Friday. The answer is definitely not. There could be a whole week go by with no trades. There could be 2 weeks go by with no trades. There may be near misses where there's a 75% probability of a trade occurring, but then the market doesn't, the futures don't do what they need to do in the last 10 or 15 minutes. That percentage goes away down to zero and there's not a trade that day. So no, it's only days where the market is, where our signal has triggered a trade. Those are the only days we will trade, and the signal is very picky. All right, but that's a good thing. I hope everyone realizes that's a good thing. Does Warren Buffett go out and buy every stock? No, he only buys certain ones, and those are the kinds of days that we like to trade on.
Seth, if I may add to that, it's very
Yeah.
common that we will have a potential or likely signal 15 minutes to the open, as you know, and then within 15 minutes, just that price action, the 15 minutes, can result in us not taking the trade. In fact, it often does. We're very selective and we're looking at short-term and longer-term action, but even that pre-open action is important to us.
All right, Emily's asking, couldn't you avoid or lessen losses by getting out early or adjusting? We could both kind of tackle that one, Scott, but let me start.
Got it.
Emily, the problem is, you could have a day where the market would go against your trade immediately and stay against it for the first 2 hours and then move in favor of your trade the rest of the day. So if you get out early, you're not giving the signal time to work out. Is it possible the signal was just dead wrong that day? Of course, we showed you examples of that, right? But if you jump out of the trade too early, when the probabilities are that it will not end up where you're jumping out, then it's not too smart to jump out. So that's why we don't have we don't have a stop on these trades. Rather, we allow the long put or the long call, depending upon whether it's a long signal or short signal, to be the stop. And that's intentional in order to prevent you from panicking. If the market's running way against your trade, the worst it ever gets is where that long put is located or that long call is located. So that gives you the comfort to hang in there and allow the signal to play out, which many, many times it will.
If I may add to that, Seth, if you recall, or back in the spring or early summer, I think it was Mike or Steve, one of the principals at SMB, whose capital is being traded with the signal, challenged us to tackle that issue. Remember, they said there's got to be some way to not hold on as day traders. And these guys are world-class day traders. They just couldn't believe there wasn't a way to improve upon the signal with other analysis after the open. And we exhausted ourselves literally for 2 weeks trying to do so. In every single scenario, everything we tested cost us money. Now, that doesn't mean that you as a client or may not have an idea or secret sauce for doing that, but we have not been successful doing it. I wish we could. Fortunately, it just doesn't happen much.
And think about it. There's a really, really just common sense reason why that kind of process has a likelihood of failure. And that is because of time decay. Because if you're getting out, if the price moves against you 20 points in the first hour, or let's say it moves against you 10 points in the first hour, that's going to cost you less if you wait till the end of the day and it ends up at that 10-point violation of the short strike than if you closed it 11 in the morning where you had all this time decay left and you were paying for that as well. You see? So it makes a lot of sense that there really wasn't a way to adjust these trades to make it anything but a worse expectancy. And we're not used to that in the options trade. We're used to being proactive and adjusting. This is a case where you make your adjustment when you get into the trade, and that's your long strike. Okay. Price drops. Tim's saying if the price drops below your long, you lose it all. That's correct. And so you do lose it all. And that is you'd have a total loss for wherever your strike separation is. So if you have a 10-point strike, you'd lose 1,000, but then you have to subtract out the credit you receive. So if you received a credit of 300, then you would have a loss of 700 in that case. And that does happen now and then. The signal is sometimes very wrong. And that all those losses are in the numbers. All of those Average wins, average losses, every single one of those scenarios is in the numbers as far back as we could figure out how to go back. Steve's asking, you usually release a view of the market with a probability of success based on the past. Should we use that probability as an additional confidence in putting on the trade? Not quite sure I understand that question. So maybe you could rephrase it and we'll go on to another one. Let me see. How often do you get a signal? Asked Tim. It depends on which strategy you're using of the ones tested. Some of them are once every 10 days. By signal, we mean a trade. We get a possibility of a trade, probably 50% of every week is a possibility of a trade, but an actual trade, it depends on which of our strategies you're trading. It could be as often as once a week. It could be as little as once every 10 days. Okay. Can the signals be used for long calls or long puts on SPY? We started testing that, John, with actually SPX options. And I would say we didn't test long enough to know, you're going to get some home runs there if you leave it till the end of the day, and you're going to get a lot of losses, because remember all the math we talked about where you've got the time decay basically working for you. Well, once you're long, it's working against you, right? So you're going to actually increase your loss rate a lot when you do that, because now you could be right on direction and still lose money. It's the exact inverse of what we were discussing earlier. So I would say it's inconclusive but that applying the signal would work on long calls or long puts. And that's all I can say right now. I don't think we can say any more than that. I think it will be a much more volatile outcome, but you may make more money because the times the signal's super right may take care of a lot of sins for the many times that it's maybe mildly right, and therefore you would not make any money. So your question is almost the opposite of asking about the win rate on credit spreads. But on the other hand, you can only have a certain size win with a credit spread, which with a long call you could have a major grand slam home run, as you probably realize, John. Why don't we take maybe 2 more questions? Steve's asking, I probably missed it, but are these illustrations based on single contract trades? And the answer is yes, Steve. All of our testing and everything we displayed today was based upon single contract trades. Tim's asking, what percentage did your signal rip through the long option and then come back? You generally don't get it at 9. I don't know what that means. That last sentence might have been responding to something that was being said. Did your signal rip through the long option and then come back? I don't know. I don't know that we tracked that, Tim. When we back tested it, we were basically looking at the beginning of the day and the end of the day.
Yeah, we haven't tracked that stuff.
I don't know that
Good
happens.
idea, though.
I don't think it happens a lot. But my observations from just trading it over the last 6 or 7 months, I don't see too many cases of where it went through the long strike and then came all the way back. But I'm guessing it's probably happened once or twice since we
had days like today where we actually had a long signal that was up big and then came back, and the futures only ended up 3 or 4 points for the day. It was a small up day,
right?
After being up, but didn't come anywhere close.
Right, exactly. So I think we're gonna wrap things up now, because this is very long for an Options Tribe meeting. People have to go out and do Christmas shopping, or I don't know what. You have to get on your computer and go to Amazon, I guess is probably more like it. But I think we'll go ahead and wrap things up. And really enjoyed everyone's questions. Hope you enjoyed the presentation tonight. Scott and I did a lot of work on this. Scott's whole team was involved in putting this together for you tonight. So if you are an Options Tribe Premium member, you'll want to check out and download the presentation tonight, because there's a lot of stuff in there, especially what Scott went over as to the study that we did of the various variables are really interesting to know, and you may want to study those for your own personal purposes.